Good morning, and thanks for tuning in this Thursday morning. It's still raining here in Mumbai, but off and on compared with the last 48 hours. I hope all of you are staying safe in the climate that we have been seeing since the start of 2020. I'm Alex Mathew, and this is BloombergQuint. As you know, you're watching Stocks to Watch, which is the program that gets you the three top picks, not necessarily only stocks, because today we're going to be talking about a sector. I'm going to introduce you without further ado to the expert who's going to help you today. My guest today is Anand Tandon, who is independent market expert. Thank you so much for joining us today, Anand.
Thank you for having me, Alex.
All right, viewers, right at the top, you've probably seen this already if you tuned in from the start. We're going to be talking about three key themes today. The first, of course, is the banking space. The MPC decision of the RBI is imminent and it is front and center. It's going to be the key thing to watch today, and we'll be discussing with Anand how you can play that theme. There's also HDFC, the QIP that was announced yesterday. We'll come to that in just a short while. And finally, at the end, we'll talk about INOX Leisure, not just about the earnings that were announced yesterday, but also with regard to the management commentary and how Anand views that business moving forward. But Anand, let's talk about the key talking point, which of course is the Monetary Policy Committee's decision, but not necessarily only that. I think the view is completely split going into this decision. We've got 21 economists that have been polled by Bloomberg that expect a 25 basis point cut, and a 20 number that expect a status quo. And there's one group that expects a larger cut of 50 basis points. I don't know how probable that is, but I think more important, Anand, from the perspective of the banking sector as a whole, is commentary that you might find during the press conference today on the moratorium and asset classification. Is that something that you're looking at very closely? And how would you play the banking theme right now?
Well, Alex, first the MPC. The MPC Act is very clear. There is a single point agenda that the MPC has been given, and that is to control inflation. Currently, inflation is higher than the MPC's target, and therefore I don't see any scope of cutting interest rates, at least the benchmark rate from here, because that would be going against the grain of what the act is actually telling the MPC to do. In fact, the act is flawed to the extent that it doesn't even mandate that the MPC should worry about growth. There is no mention of growth at all. There is simply a question that you have to keep inflation under control, and the single point tool that they have is to keep interest rates higher than to keep real interest rates positive. Right now they are not. Therefore, my argument would be that it would be not very prudent on their part to cut down further in terms of the benchmark rate. There is, however, scope for improved transmission. I mean, the cuts have not all been passed on. In fact, for the smaller companies, the MSME sector, the rates are pretty high even now, despite whatever the benchmark will be doing. So I would assume that the RBI will be spending a lot more time trying to figure out ways and means to have the rate transmitted to the MSME sector rather than actually looking at cutting benchmark rates. Your second question was, what do we do with what is our view in terms of the possibility of a large rise in NPAs once the moratorium is lifted? And I think the RBI has already said it in their recent commentary that they expect the post-moratorium period write-offs to be fairly substantial. And I don't see why not. I mean, at the end of the day today, if there is someone who's able to pay, why would he be paying compound interest rate, especially if he's in the MSME sector, where, as I said, the interest rates are way higher than they could possibly be. And consequently, if you are today still taking on the moratorium rather than paying off your dues, there can only be one reason: you have no ability to pay off the loans that you've taken. Which means that if you have companies and you have a variety of them saying that anywhere from 8% to 25% or even more is the kind of moratorium that some of their clients are enjoying, you have to assume that at least a double-digit NPA is going to be a reality. And you can also see that from the fundraise that many of the companies are doing, where despite the depressed prices that you're seeing for the financial sector, and that's been one sector which hasn't really come back to the peak levels, unlike a whole lot of others, people are still going out and raising money wherever they can, which clearly indicates that the managements themselves, despite their commentary, continue to see a fairly bleak future. So I would be rather hesitant about what kind of stocks you want to pick in this kind of environment. I think it is better to be still somewhat underweight the financials, especially those where the liability profiles are a bit suspect.
Okay, so that's an interesting comment. And in fact, it leads us very neatly into the second conversation that I wanted to have, which is also in the financial space, but has to do with HDFC, and it has to do with the fundraise that they just announced yesterday. To the QIP announcement, 14,000 crore rupees through equity and warrants, and a further 9,000 crore rupees that will be raised through, or up to 9,000 crore rupees that will be raised through NCDs. But the floor price that was announced yesterday was 1893.94, which is higher than the closing price yesterday. Of course, they have the leeway to raise at a 5% discount to that floor price, remember. But how would you see that in the context of everything that we've seen? You just spoke about the fact that you're a little wary of developments in the financial space. They're a mortgage lender, and one would think that there could be a large number of moratoriums that are taking. However, seen in context of the commentary of the management, Keki Mistry came in after the results at the end of last month and said that most of the provisioning that was required for COVID-19, Anand, has been done. So you would not expect a large amount of provisioning, or rather he doesn't expect that much going forward. In that context, how do you see this latest fundraise, and how would you play HDFC?
So HDFC has always been rather proactive in raising money. They did it even after the ILFS collapse, and they were ahead of the curve in terms of trying to raise more money. And they are probably doing it again today. Among the players with the quality of book, I would argue that HDFC probably has one of the best qualities of book even now, though the premium is kind of easing off, largely because they have been lending more to the builder community, which is not something that the market particularly favors, and where the valuations are very high. So from a book point of view, it is worse than what it used to be, but not as bad as many of their compatriots, and therefore you would still assume that from a mortgage lender perspective, HDFC is one of the best. The challenge, however, that remains for HDFC now is what do you do with the cash that you are deploying, because much of your book, almost half of it, is today coming from an investment book, and that investment book has become so large that it is actually pulling down the ROE for the business as a whole. And there was some talk a while back of two things. One, that is HDFC will increase its stake in HDFC Bank Limited, which in my view is a very, very bad idea. HDFC Bank does not need HDFC anymore. It doesn't need them as parents. It doesn't need them as management. The only problem I see is for HDFC to give up control of its so-called child, because they still want to have control over who they appoint as a CEO, which is not required at this stage anymore. So HDFC would be well advised to stay away from trying to do anything with HDFC Bank. The other issue was, of course, trying to merge the two, which hopefully is not likely to happen now, because if they are raising independent money, if they were looking to merge, they wouldn't need to raise money. HDFC Bank has a huge liability franchise. They should not have a problem financing it. So to that extent, one could argue that maybe this is a signal that they are not really going ahead with trying to force a merger through. So on a standalone basis, the problem with HDFC today is what do you do with the cash you are raising? You are in a business which is becoming less attractive for the near term, and the non-business book is become so large that it's driving down your ROE. So from a market perspective, therefore, the upside becomes somewhat limited. So you are reasonably expensively valued. Your ROE is continuously falling. You are having to force yourself into the builder loan category, which is not necessarily great. And so till you find a way to kind of, maybe it would make sense for HDFC, for example, to divest part of their, or at least split up their investment holdings and their business separately, and take it up forward from there. Very unlikely to happen, but would actually unlock some significant value.
Stay away from HDFC at this point?
From a portfolio perspective, if you have to have positions in financials, so you may want to be in HDFC, but it's not likely to show you the highest growth rates from here on. You are still likely to perhaps get better upside from an ICICI Bank, or even perhaps an HDFC Bank, now that the clouds over it are kind of gone in terms of who the management will be. But the overall sector still remains more than it should be weighted on the index. And given my view on the index that we are now close to a top, it's a little difficult for the sector to outperform. So I would still be somewhat underweight.
All right. So, Anand, the last conversation that we're going to have will have to be a little bit of a brief conversation. It's while we're talking about INOX Leisure, it's more of a thematic conversation. They announced their results yesterday, and it was to be expected that it would be a washout. We've seen 100% drop in revenues. You've seen a dramatic loss from a profit in the comparative period. And you saw also the management commentary where they've made representations saying that they hope that there will be a resumption in operations in Unlock 4.0. Whether or not that happens is unclear at this point. And in fact, Anand, whether or not people will go, even if there is a resumption in operations, is in question. So how would you play INOX Leisure? Is it something that now you would say if people hold in their portfolio something that they should have a relook at?
Long time kind of view. Frankly, this is the patient in the industry is a patient in ICU. I mean, you've pretty much shut it down, so there is no business at all. It's unfair to look at the numbers and try and make a comment on it. The other point of the business is that it's largely driven by new movies coming through, and it is a weekend business. At best they have 42% kind of occupancy. So if you are looking at a situation where you have to reduce the occupancy because seats have to be left blank and so on, anyway, it's not going to be making a lot of money from that perspective. More importantly, as you mentioned, will habits change so quickly? People will give up their risk. Well, in places like Bombay, etc., maybe there is still a market for people who want to go out of their house because houses get constraining, and you need to move out, and for your own sanity. But in other places where that is not so much of an issue, I doubt very much that you will have a great uptake, especially if you're going to show old movies. So, you have to assume that the better way to play this segment is actually OTT. And perhaps here again, Jio, in a manner of speaking, is probably the best bet, perhaps followed by by Airtel, rather than actually looking at, and perhaps some of the producing companies which are actually producing the content, rather than the channels right now like INOX. I mean, they're going to have a long time, at least not for the next 12 months, unless a vaccine comes through, which everybody is able to access and feel comfortable after.
Let's stay hopeful for that. Before we end this conversation, Anand, I'm going to put you on the spot. What's your top pick in the short term?
There is actually, like I said, I am somewhat not so bullish on the market. But if you have to be in the market, I think you have to be better. You're better off staying the frontline leaders. A contra pick to my mind would be something like State Bank of India, of course, with the caveat that it's very likely that some other bank may get merged in it if the moratorium situation becomes worse. But some of the places where there is deep value is things like NTPC. Most of the government plays stocks are actually trading very low. And at some stage, I think oil will come back. There is already a case to be made that the supply of oil is now lower than the demand. Demand seems to be suddenly picking up, and inventories are falling off. So you may be surprised to find an uptick in crude, in which case some of the players in the ENC business may actually do quite well.
All right, clearly a lot of themes to watch out for. Thanks for leaving us with those thoughts, Anand. Thank you so much for joining us today. And to you, dear viewers, thank you so much, dear viewers, for joining in on this conversation. There's a lot more on BloombergQuint in just a short while. Of course, front and center, like I said at the start of this conversation, is the NPC's decision on rates. You'll find all the action right here on BloombergQuint, so don't go anywhere. Once again, thanks so much for watching. Have a great day.